Hi, and welcome to my monthly market insights video. My name is Dan Timotich. I'm a managing principal and portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. The opinions expressed in this video are mine and do not reflect the opinions of others. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, well, we just came off one of the best performances August has ever seen. In my 26 years, I have never seen the type of performance we've had in August. Probably because the last time that happened was 1986, 34 years ago. Generally speaking, everything did well with the exception of bonds. It seems like they lost money. This should be of no surprise to anybody considering the Fed has been pumping trillions and trillions of dollars into the system and continues to force people into riskier assets. So since everybody's been talking about 1986, I thought it would be important to kind of look back. Here we have a chart of the year, the S&P 500 in 1986. And as I mentioned, it had a phenomenal August back then. The market was up about 7%, very similar to what we saw in this last month. And the question becomes, what happens after that? Not that history exactly repeats itself, but, whenever you have such a strong month like we did back in 86, it's important to see what happens following that. And as you can see, in September of 1986, the market gave back almost all of those gains. So I just want people to be cautious, and I don't want them to be just too complacent about seeing a single month's run up like it has. Clearly, anybody that was defensive in August underperformed and didn't capture all of that gain. But again, risk management is one thing, and when you have a Fed pumping liquidity and you have so much speculation and euphoria in the market, volatile and violent swings in the market do occur. So, everybody's been asking me, the market is doing great, and they want to know if that's broad-based, and the answer is simply no. Here we have a chart from Albert Bridge Capital. It's interesting here because if you see the graphs, they're starting from the left to the right. These are all basically the entire Russell 3000 with the exception of the 5 major stocks over here. You can see this is Facebook, Apple, Amazon, Microsoft, and Google. Those 5 companies represent about 36% return. And you can see all the other stocks within the Russell 3000 have significantly underperformed and have all basically been negative. So if you had no exposure to those major tech names, you really, the market hasn't been very rewarding for you. Moving on to things that kind of make you scratch your head a little bit, the Apple has had a tremendous run up. This here is courtesy of Mike Gayed from Lead Lag Report. He tweeted this graph out, and I thought it was interesting. Apple's market cap as a percentage of the Russell 2000. The Russell 2000 is basically the entire small cap index. And as you can see, this one's a little bit dated, but at one point, Apple was larger than the entire small cap index. And that's really a staggering statistic, and it should cause people to at least pause and reevaluate whether or not the significant run-up is justified. Now, I know there's a lot of people out there in today's marketplace that probably haven't been around in the late 90s, but I was, and I remember it vividly. And I wanted to spend time on this video talking about how many similarities we have to the late 90s. I realize that people are all saying the interest rate environment is different today, so you could justify higher multiples, and that's true to a certain extent. But let's go through some of these similarities that we see today relative to the 90s. Back then, we saw a lot of money losing companies going public. We're seeing that happen again today. Stock splits were pushing prices significantly higher. Valuations back then didn't matter. I remember people saying that the old all the measures of the markets are no longer valid, and we need to find new ways to evaluate whether or not a stock is good. Day traders 2.0. We've seen the rebirth of day traders today, and my favorite, it's different this time. So why don't we start taking these issues one at a time? First and foremost, the IPO market is definitely heating up today. We've seen the newly listed companies have gained on average 20% on the first day of trading. That's the highest gain since the tech bubble in the late 90s. We also saw the creation of what's called special purpose acquisition companies, SPACs. These are basically blank check funds that people give money to, and they are responsible for bringing companies public. And if everything seems to be at the beginning of a bull market, why is it that so many early investors are looking for a liquidity event? These are the exact same things that happened back in the 90s. As an example, there's a company called Palantir. It's a data analytics company. They're planning to go public here. Talk is that they could be as big as $20 billion, and that could be basically the biggest tech IPO since Uber. Just for perspective, that company's been around since 2003. It has never seen a profit. Last year, it had revenues of about $743 million, and on those revenues, it lost $580 million. So how do you justify $20 billion valuation? That's anybody's guess, but definitely you're starting to see the IPO market heating up. The next one, and this one will be mind-boggling, but stock splits back then were on a rampage, and it's happening again today. Here we have a chart of Tesla. Obviously, everybody knows the story of that. Back in August 12th, it announced a 5-for-1 stock split, and since that time, the stock rallied over 80%. This is mind-boggling from a mathematical perspective. It's like saying if you have a $100 bill in your left pocket and you exchange it for 5 $20 bills, you somehow miraculously end up with $180. The math just doesn't work, and this reminds me back in the late 90s when there was a company, Qualcomm was very similar to this. It was the darling of the market, and at the end of 1999, it did a stock split. The market rallied on that stock split, or actually the stock itself rallied on that split, and that marked the peak of Qualcomm going into 2000. So just something to be very careful for when you see this kind of euphoria over a stock split. Valuations don't seem to matter. I guess this is very similar to the 90s. So let's take a few companies: Amazon, Apple, Zoom, and our favorite Tesla. So Amazon, 2019, the PE was about 80. Today's PE is 130. The earnings have only been up about 9% on a one-year basis, and yet the stock price for the year is up 87%. You look at Apple, same thing. These are all great companies, but when you were paying 18 times earnings last year, today you're paying 38 times. The earnings were only up 14%, and the stock price is up 77% for the year. Interestingly enough, the revenue growth of Apple is less than 6% on a one-year basis. Zoom, these valuations are just outrageous. Last year it had a valuation that was silly back then at 850 times. Today it's nearly 1,900 times. Earnings were absolutely amazing this last quarter, but given that we've all been quarantined and the economy was shut down and everybody's doing things remotely, it's hard to believe that they could continue to maintain this level of growth. Stock price this year up nearly 400%. Tesla, last year, it didn't have a PE because it didn't have any earnings. Today, the PE is at 1,300 times. They finally generated some earnings, albeit it was primarily from selling some emissions credits. And the stock price is, year to date up 500%. So, when you're investing in stocks, you're basically making a determination on how much are you going to pay for future earnings. And if you're willing to pay these astronomical levels, I'm hard pressed to believe that you're going to see some really good performance of those companies going forward, or at least less than what you would expect. And my favorite now, the new day traders. Back in the 90s, we had people that were quitting their jobs, construction workers, teachers, plumbers, you name it. They were all quitting and doing and entering the day trading environment. Well, today, people don't have to quit because so many people have been laid off. The government gave them so much money to play with, and they're sitting at home bored. And now with the companies like Robinhood and all the fractional shares, it makes it so much easier for people to day trade. So I thought I would take a look and see what Robinhood looks like relative to the Tesla holdings. They publish this. You can just go ahead and look it up on your own. But this is for the year. So the green line is basically the number of users that are holding Tesla stock, and the pink line is actually the price of Tesla stock. And you could see as soon as the quarantine hit, you started to see the increased number of people holding Tesla stock and how that's been pushing up the price of Tesla. And as recently, you have over 550,000 holders on this Robinhood platform that hold Tesla at a price that's just absolutely mind-boggling. So day traders are definitely back, and they are definitely speculating on the market. So the favorite one that I mentioned earlier, it's different this time. This here is a chart of a stock that looks probably pretty similar to many that have that you've seen this year. This one right here is particularly Qualcomm. And as you can see, it didn't do anything for about a year and a half. And then all of a sudden, about March, April of 99, it started its ascend directly vertical. And the market basically rallied up 2,600% in 1999. And people were saying it's the internet, it's the future growth, valuations don't matter. And then what happened in 2000 after they stock split, the market just continued to punish that stock to get it back to more reasonable levels and more reasonable valuations. I'm not saying this is going to happen today. Interest rates are low, and you have the Federal Reserve that's 100% behind you. But nonetheless, history may not repeat itself, but it does rhyme a lot. And when valuations and markets get stretched like they have recently, you have to be cognizant of the risk of a potential sell-off. So just taking a look at it differently, you look at top chart here is Qualcomm. The bottom line is Tesla, and again, similar situation. We could look at it from a general market perspective. The top graph here is the NASDAQ in 1999, and the bottom is the NASDAQ in 2020. In 1999, it took about 2.5 months for the NASDAQ to rally about 60%. Today, it took more like 5 months. So not exactly the same, but again, similar euphoria in the market back then as there is today. So, given all of this, what do we need to be worried about? We got to be worried that the market is overextended. By any measure whatsoever, you could see that there's just the market has gone very, very far. Risk continues to build every single time it ratchets new highs. You start to hear analysts now are raising price targets on some of these companies that have outrageous valuations to begin with. So that's going to cause a bigger concern if people start taking their advice and start buying these overvalued stocks, expecting even higher target rates. Clearly, in the last month or two, defense has not been paying off. I feel that that's about to change. And people should be concerned about the frothy market levels that we're at right now. And so I think people should really start to evaluate their asset allocation more carefully going into the next coming months. Okay, I appreciate everybody watching the video. As always, if you have any questions or you want more information on what we're doing here, please feel free to either send me an email or give me a call. Hope everybody enjoys the Labor Day weekend, and we look forward to seeing you next month. Take care.